What's up? I'm Colton Lindsay, financially free by the age of 32. Today, my team has some videos put together from the Money Guy Show. I actually have no idea who this is, so I'm excited to dive in, and I'm going to share with you my reactions. Along the way, I'd love to see your reactions in the comments below, and give it a thumbs up or a thumbs down if it sucks. I don't really care which one you give it. Let's go.
Don't be shocked when you get to your first $1 million. You'll be to $2 million probably within 3 to 4 years. I think about the whole boiling point of creating wealth creation is that I remember my first $10,000. I've had parts of my life where $1,000 would change my life. Yeah. $1,000 would make me a better person and not have the stress and other things. So 10,000 was a big point for me. And then you fast forward to 100,000, and once you get to 100,000 and you start seeing the money build upon itself, you're off to the races. You're kind of reaching that critical boiling point of having escape velocity that this thing is taking off on you. So that by the time you reach 500,000, you're now amazed that months of work are being replaced just with your money growing upon itself. That's what I get people excited about.
I completely agree. I think it took me like 10 years to get that first million. But then it took me like a couple years to get that next million. It just builds upon itself. And that's how compound interest works in two different ways here. Number one, it works with the money itself because 10% of $1 million is more than 10% of $100,000. But the other way compound interest works is I'm a better version of myself. I can actually generate more cash in my business that allows me to put more money aside, invest more money. I have more opportunities as my wealth grows to invest in different projects that make me better rates of return. And so I completely agree with what he has to say. This is a really cool video. What are your thoughts? Drop down in the comments down below.
Instead of this being a 5 to 7 year decision, I would say with interest rates this high and with the market value of houses still high, I would go beyond the 5 to 7 years we talk about. I would go, this is a 10-year decision. There is going to be pressure with high interest rates that's going to pull people out of the market in their ability to buy. It is going to create some softening on the real estate marketplace. I think it's okay if you wait, if you can, if you want to see, hey, will prices start coming down? But I will tell you, do not go get yourself in a headache of a house purchase where your house rich, life poor. You make the decision based upon this is a 10-year purchase decision.
Look, 5, 7, 10 years, I don't freaking care. He said one thing, don't wait to buy real estate. I think that's a horrible mistake to wait. My philosophy is don't wait to buy real estate and wait. Now, I think your strategy of which going in to buy the real estate has got to shift. And I see a lot of people getting smoked right now in buying short-term rental vacations, especially as their first ones. They're running projections off of old data that's been built up, but they're not running off the projections of the slump in the Airbnb market, and they're getting really hosed right now and losing money. I'm seeing people down as much as 50%. We're going to continue to see some pressure from that. And I think sooner than later, as the feds keep the rates up, you're going to see that those people are going to liquidate those houses. And they might not get as much out of it as they originally did. But you got this other thing that's happening right now with the low interest rates that people have, 3.25% or whatever. I actually think that with time, they may get bored of staying in their house, and there will be some creativity, whether it's through loan assumptions or arbitrage on all-inclusive deed of trust, seller finance deals for those type of people where they get a big, because they got a lot of equity, right? But can they tap into that equity? And maybe someone's got like a 4,000 square foot house and they only need a 2,000 square foot house, so they sell it at 1.2 million on a 6.5% wrap, and they only owe 3.25. They're going to make that 3.25% arbitrage plus the inflated price, and they're going to get a chunk of money down. They're going to go put onto that house or that townhome or the 2,000 square foot property. They're going to bring the price way, way down. It's about a $4 billion. They have kind of two assets at that point. So I think there's a lot of opportunity, but don't wait to buy real estate. Buy real estate and wait. I think you got to be very clear on the exit strategy. And I think finally, I do agree with this idea. Don't make yourself house poor. But also understand the way the economy works today, and it's through transactions. You got to find out where the transactions are happening so that you get a percentage of that deal to go from other people's banks into your bank. Because many, many people, like, for example, the real estate space right now, they're suffering. They're down 40, 50%, whereas our company's up 50%. It's because we understand where the money's flowing in the marketplace, at least for now. I would like to pretend I will continue to understand that, and I think that I will because of innovation and anticipation with the way the marketplace is going. The biggest strength that I have is my ability to adapt quickly when what was working is no longer working. And it typically starts with your marketing message.
You got get wealthy activities, and then you got stay wealthy activities. Paying off your mortgage is definitely a stay wealthy activity, but you got to also make sure you first get wealthy first. And I think that's the problem I have with paying off a low interest mortgages. I've seen a lot of people have regrets about that, is because they paid off something at 2 and 3%, and they're like, what in the world was I doing? When you could have been investing that money. I want to get you too wealthy before I have you doing activities that are to stay wealthy. It's all on that. What's the opportunity cost of a transaction?
Look, I completely agree. I mean, you got a 3% interest rate on your home. Don't pay that house off. You go put that money into something else and you make 10, 20. I mean, I got projects that are paying me as much as 30, even one project I've made 100% return. Now, you're not going to get 100% return on your project, but to get 15 to 20% is very reasonable in today's market. In fact, almost a necessity. If you're getting that 8 to 10%, you better have it in like a high yield cash value guaranteed whole life policy, something like that. That's the only way I'll do a single digit rate return is my cash value guaranteed whole life. Besides that, I better be getting at least 15, 60% minimum annualized rate of return, ideally more than that, to really grow my wealth. So why would I go pay off my house if I have a 3% interest rate? Well, it's because I got a shit ton of money. That's the only reason I would do it. Is like, look, I'm just going to put some money, I'll pay this off, so I don't have to do that. I'm going to reduce my expenses even more. But there's a timing when to do that. I'm not at that stage of my life yet. I still rock a 3.25% interest rate on my house because it makes sense. In fact, I have another house where we rock a 6.5% interest rate. Why? Because it makes sense to own real estate. It makes sense to own and have my money growing in the longevity of everything.
Let's assume that you have an emergency fund of $30,000. If you think about that $30,000 sitting in the average savings account earning 0.36% interest, that's $108 a year. That'll maybe take you out for a nice dinner. Contrast that to if you have a high yield savings account that's yielding 4.75%, now you're talking about over $1,400 in interest for nothing, just simply changing the account that you hold your cash in.
No actual physical labor on your part. You didn't have to work any extra hours. You didn't have to go take a gig economy job. All you have to do is make sure that your cash is not being taken for granted, and you can actually have a 4-figure change in more money coming in.
I am really enjoying this dude. I don't know how I've never heard of him sooner. What he's saying is this idea, a belief I've developed many years ago from my mentor, Harv Eker, is my money works hard for me and makes me more money. All he's saying is, hey, change from one account to a higher yield interest account. I think you take it one step further where you can really take it offline, go to a guaranteed whole life insurance policy. And I'm not saying this because I sell insurance. I'm not an insurance salesman, but I am a proponent of it. I got multiple policies on myself, my kids, my family, because I understand that I can have that high yield 5% money off the table that's taken off the radar, and that after about 3 years, if you're using a rider on that and overfunding the policy, it's actually going to grow at a ridiculous amount, and it is one of the most incredible things. And there's a 100% guarantee you're going to fucking die one day, so when you do die, now just imagine you give that $3, $4, $5 million to your family trust and what that will advance the family with the next generation. So I love this. The only thing I would say is don't go to necessarily like a high yield savings. Go to a high yield cash value guaranteed whole life account.
Cars are supposed to be transportation, not something to impress your peers. When we talk about 20% down, don't amortize longer than 3 years, and your payments can't exceed 8% of your income. The 3 years is the part that I think squeezes people, because that's going to keep you honest on how much car you can actually afford. What the car industry is doing is that they just keep expanding how long you can finance it. We've shown in a lot of case studies that on a 3-year payment would be around $20,000 of financing. If you expand it out to 6 or 7 years, it balloons up to over $40,000. That looks great if you're selling vehicles. It's horrible if you're trying to figure out how do you keep yourself from getting in too much debt. Do not fall into that trap. The 3 years is there for a purpose. I want you to be thinking reliable transportation, more of the Corolla, more of the Civic. I'm not wanting you buying the Sequoia or, whatever the fancier version of that baseline is, because you're going to get yourself in a pickle of a situation.
Look, I don't know who his audience is and who he's talking to, but there was a time in my life where I had no problem driving a Honda Civic or a Chevrolet Cavalier or even a Ford Focus. I get it. I think you got to have to look at what stage in your life are you? And if I'm going to be in the stage of my life where I got lots of money, I'm okay getting a nicer vehicle, and I'm okay going above that or I guess, I don't know, I haven't even checked the 8% number, truthfully. Maybe I'm not doing 8% of income, maybe I'm doing less, but I'm okay expanding longer than 3 years. I think his rule makes sense. I think you have to look at the audience that he's talking with. Where is your income? And if you're in the early stages of building wealth, I think he's right on. But if you're in the later stages of building wealth, maybe he's right on. I haven't really looked at it. I haven't ever had a problem with my car payment, but what he does do that I really like is creating some rules that someone can follow.
Why is the recommendation to keep your emergency fund in a high-yield savings account instead of a diversified low-cost ETF?
What is your emergency fund for? It's for an emergency, right?
It's true.
When an emergency happens, you want to make sure that you can get to those dollars. So I'm gonna argue in that low-cost ETF, what'd it do in 2022? What'd it do in the middle of COVID?
Shawty, what that thing do?
I don't think you can be so aggressive and so risky and so dangerous that you put your emergency fund into something like that, because at the time that you need it most, there's a very high likelihood it won't be there for you when you need it.
I completely agree with this, because what is the purpose of an emergency account? It's the secure bucket. And if you're doing something like an ETF, I don't even care if it's low-cost ETF. You can get tons of different ETFs, put money in there. I mean, you look at what happened so many times over the last 8 years where people in the ETFs, they just got freaking pounded, which is opposite of the goal of having a savings account or a safety account or whatever emergency account. I do believe, and I've said it multiple times in the reaction video today, is a guaranteed cash value whole life policy. It's off the table, it's off the radar, and the time that you're probably going to need that money is actually when the markets are getting hit the most, because maybe, like I'm watching this with real estate agents today, their incomes are down 40, 50%. But if they had $500,000 in their cash value account, they would not be freaking worried right now, trust me. Like in this economy where real estate sales are down, and assuming my other business wasn't doing so well, because it is, but assuming it wasn't, I would be so fine because I have so much money into a secure bucket in my investment portfolio. In fact, I split it up, 40% secure, 60% higher risk, faster growth, wealth building type investments that I know that could be out. In fact, some of them are down, but I'm not worried about money because I have that safety account. But if I had that safety account in Bitcoin or an ETF, I'd probably be worried about it right now. I'd be like, shit, I need the money and I'm missing 300,000 of it. I need that 300. You see what I'm saying? But with cash value whole life policy, you won't have to worry about that. You'll get the high yields on it, and you'll get the guaranteed death benefit with it as well. I love what they're saying here. Lit Gang, I really appreciate you stopping by on today's videos. It's great. I actually love the Money Guy show. I would love to know what you think of in the comments down below. Make sure to hit that like button. Share this with a friend, because I think there's a lot of great principles that people can learn from this Money Guy, and it would be crazy for not to share that with other people and help them, especially where we are economically and in the markets today. Where people lack is a financial certainty or security, and the way you get security is by your knowledge. Now, knowledge always triumphed by execution. You got to do that. You got to execute on this. So, I mean, you got to take some of these rules that he's shared today, but go create some financial rules, and it's about learning the money management game. You do that, you win the game, the new game of money today. You know the rules, you can win big time. Thanks for watching. We'll see you later.